Okay, so my largest position is up around 7% after hours after smashing earnings. So in today's video, I'll be covering some of the earnings reaction to all of the companies that I own. And for reference, this is my portfolio here. I update this weekly on the channel, so feel free to check it out. And in today's video, the first portion that I'll be covering is Google's earnings, of course. So Google is up around 7% after hours after smashing earnings. The stock was up around 7 to 8% leading up to earnings already. So it was an entire 15% up move after this earnings report. So for Google, everything is going in the correct direction. So Google's search actually went up by around 15% in terms of revenue. YouTube went up by 10%. Google Network had a slight drop. Google Cloud is re-accelerating in terms of growth. It's increasing by around 35%. So overall, the company's numbers are all moving in the right direction. Everything seems fine for the company. And for Google, if you're to look at their operating expenses as well, operating expenses is not up 28%, it's up around 13%. It is because of a one-time expense that they had to pay. It was a fine. So if you're to discount for that, the operating expenses only increased by around 13%. So overall, if you're to compare this to their revenue growth, for example, revenue growth is up at around 16%. So 16% revenue growth, expenses increasing by around 13%. That means that their net income or their operating income will grow a lot faster than just this 16%. So overall, if you're to discount away the fine that they had, the operating income would have gone up by around 22%. So this is an incredible report and it shows that the company is moving in the right direction. But of course, there are some nuances to this. So Google search actually grew by around 15%. So the company said that it was 7% volume growth, 8% pricing growth. Meta had around, I believe, 10% pricing growth. So there was an acceleration of users, of course, but we need to measure the sustainability of this growth. And if you're to granulate it, internet penetration is around 1 to 2%. Means that the user growth for Google is probably around 2%. So what that means is that there is increased query growth for Google, which is probably linked to their AI mode as well as all the innovations that they had this year. So for Google's volume growth, I'm leaning more towards that the volume growth is not sustainable in the long run. They already have a very high market share and a very high internet penetration rate. So it should normalize towards a 2 to 3% annual growth. And if you're to add the pricing growth for this company, that would be around 6 to 10% growth in terms of search. So I think this 15% growth this quarter is probably elevated. So my conclusion for Google is as such, the stock is not cheap right now, but the story is very, very strong. They have a cloud that is growing at 35%, growing operating income in that division by upwards of 50%. And I don't think the market has priced in the 15% growth in search yet. The story breaks when the other segments start to fall, but for now, it's still my largest holding, and it's a company that I'm still bullish on. Of course, the valuation right now is a lot higher than what it was just a few months ago, but this is a company that is fundamentally still very strong. I'll be doing a reverse DCF for this and check how much growth the market is pricing in and whether or not I think that growth is justified. Adding on to Google's valuation, this is my Google's model for the company. So I initially modeled their search growth at around 8% this year. So of course they're smashing it already. So this could go up. And my fair value estimate for the company at that time was around $215 a share when I did this model back in September of this year. That's why I decided to trim my position initially. The company was slightly overvalued and I wanted to reduce exposure. But of course, it turned out the other way. The stock has been going up non-stop. But for this company, I think the growth is not sustainable in terms of volume increases unless they can release an AI mode every single year, which is of course subject to innovation risk as well. The volume growth cannot continually grow at 7%. Historically, it has grown from around 19% to 5% last year. So I expect this to continually decelerate over the next few years, because your global search query growth is only growing at around 1 to 2%. Internet penetration is also at around that same rate. So for Google, I think the market is pricing in a lot today. And even if I were to model this for 7% volume growth and 7% pricing growth, and if I were to change the Google Cloud portion from a 30% growth to around a 35% growth, this company is still expensive today. I think it's reasonable for you to trim your position now. I'm considering it as well. So we'll see how this one plays out, but overall I think Google is almost fully priced today. Next company that I'll be covering is Meta. So Meta reported earnings, and post the earnings result, the stock is actually down around 7%. So for Meta, their earnings were decent of course, and it was because of a one-time expense that actually decreased their earnings by quite a fair bit. So if you're to discount for that, their diluted EPS would have gone from $6.20 to $7.25, which is up around 22% year on year, compared to the reported diluted EPS of $1.05. So for Meta, these are some of the metrics that they released this quarter. So daily active users is up 8%. I can't believe they're still getting people to sign up for their apps. Ad impression is up 14%. Ad prices up 10%. Revenue up 26%. This is a company that is still growing very strongly. Costs and expenses is up 32%. So this is the worrying part about Meta. Their cost is actually now increasing faster than the revenue. And besides that, they also said that capital expenditure is at around $19.37 billion. So for Meta, the spending is crazy. Large amounts of their free cash flow is actually put into capex, and their expenses are rising also. So revenue went up by 26%, expenses went up by 32%. So this is not sustainable in the long run. You want companies where the expenses grow a lot slower than the revenue itself, so that the net income can grow a lot faster than the actual revenue of the company. This is operating leverage, of course. So for Meta in the entire earnings report, I think this is the portion that is a bit worrying. So unless you believe the management can deploy capital into smart capex, this is not sustainable. And they also said that next year, the expenses will grow at a much faster rate. So this year expenses is up 32%. Next year it could be up around 35%, 36%, who knows. But if the expenses continue to increase at this rate, it is not sustainable for a company like Meta. It's a lot of expense-driven growth, which is not sustainable in the long run. So that's why I'm a bit wary about Meta. I don't think the capital allocation there is conservative. I much prefer a company like Google with Sundar Pichai. Next portion, I'll be covering Mercado Libre stock. So Mercado Libre released their earnings yesterday. They beat on the top line and then they missed on their bottom line. So let's take a look at their earnings here. So GMV increased by 28%, items sold increased by 39%. Overall, I think this company is growing very healthily, but this portion is a bit of a concern because they're rapidly increasing their credit portfolio and it is under the company's books. So I think I've spoken about this company before. This company is one that has strong secular growth trends behind of it. And over here, as you can see, unique active buyers is up 26%. So the internet penetration story is still very strong for Mercado Libre. And overall, the revenue growth and everything is doing very well, but they're not optimizing for bottom line growth yet. I think the only concern for Mercado Libre is simply just this portion here, which is their credit card as well as their consumer credit portfolio. So majority of it is actually made up of credit card as well as consumers. So that could be subject to default risk, that could be subject to your delinquencies and so on. But this credit portfolio portion is one that I cannot really grasp yet, and that's why I haven't bought into this company. And I don't think the valuation today is extremely sound yet. So the company is still currently trading at a 56 times of earnings. Of course, the company is not optimizing for earnings yet, but for a company that's growing at 56 times of earnings, I would have expected the EPS to grow a lot faster. But because they have this portion and the NIMA is dropping, so that's why the EPS is getting hit this year.